All right, everyone. My name is Tom Dufour, and welcome to another edition of Moving Beyond the Coronavirus Economy series, presented by Big Sky Franchise Team. And as all of our guests are loading in for the presentation today, we are in store for a great treat to be talking about what's happening in the commercial real estate industry. And Morrow Hill is here joining us to share their industry expertise and knowledge to go over exactly how and what is happening and what you should know or know about as it pertains to commercial real estate. So if you have any interest in the commercial real estate business, what's going on, this is the episode for you to be tuning into. And I'm pleased to be joined by the Morrow Hill team, and they'll be taking away some introductions, give you a little overview on their organization and their team. But we have John, Jonathan, and Linda joining us here, who will be providing us some amazing information. So with that, I'd love for you all to go ahead, take it away, and get us started.
Thanks, Tom. Nice to be talking with everyone today. My name is John Hill. I'm the co-founder of Morrow Hill, and joined here with Linda Nguyen and John Bolsins. We're excited to share a real estate market overview with you and tell you a little bit about what is going on, and maybe clear up some of the rumors as you see in today's media. And so we're excited to kind of get into it. We most certainly have a lot of information to share, and then we'll open it up with some questions towards the end. Perfect. So what is Morrow Hill, and who are we, and what do we do? So Morrow Hill, we are the premier commercial real estate leasing firm in the country. We do represent some of the largest franchise brands in the world. We are essentially a location management solution that represents franchise brands on a national basis, and we're unique because we exclusively represent tenants, end users, and buyers of commercial space. So we have no conflict of interest. We do not represent landlords or property owners. So that is a very unique aspect of us. We also are unique because we do build what we call dedicated client teams around the brands we serve. We scale and we grow with them. So we do not sub out transactions, and we are not part of what's called a real estate flag or chain model. So that makes us quite unique. And our firm has been in existence for a little over 20 years, and we've been very much entrenched in the franchise real estate community for about 9 years now. So Morrow Hill by the numbers. We do represent about 3.5 million square feet of the retail leased annually throughout the country. It equates to about 8 to 9% of the franchise real estate community. Again, we don't represent landlords. And so that does allow a nice lens that we share through our franchisees and franchisors. We think that's really important. And then that's about 1,000, give or take, franchise real estate transactions managed annually for us. First off, I want to thank our data contributors that provided data for us today to share with you. Oxford University, Cornell, Harvard, Northwestern, Federal Bureau of Labor Statistics, National Federation of Federal Reserve Board, and CoStar for compiling this great information for us today. We're excited to get into it. We promise we'll try to make it as exciting as possible and as fun as possible. All right, so what is going on in the real estate market? You see some big stats at the top of this page, and there's a couple that hopefully should stand out to you. The 12-month deliveries is 42 million, and you have a 12-month net absorption of 82 million. What does that mean? Well, that means there was a lot less product delivered than what was absorbed and leased. So that is very lopsided, and we'll get into that a little more in some future illustrations. Your vacancy rate, 4.6%, and we'll get into that a little further, and that'll mean a little more as we further illustrate that. This is a pretty staggering rent growth number at 3%. So that'll mean a little more as we go into this, but I wanted to highlight those first as we kind of get into this. So Let's dive in and understand this a little bit more at a micro level. The retail sector it really enjoyed what I call a pronounced rebound in 2021. A fiscal support provided by the U.S. government throughout the pandemic provided consumers with trillions of extra dollars. While a tightening labor market, historical level of job openings have supported relatively robust wage growth, especially at the lower end of the income ladder. With additional funds at their disposal, American consumers pushed brick and mortar retail sales to record levels in 2021 on both a nominal and a real basis. Shopper foot traffic has returned to pre-pandemic at most open air lifestyle centers, while a majority of national retailers are reporting higher same-store sales relative to pre-pandemic levels. In addition, the number of retailers filing for bankruptcies has declined to a 5-year low, while openings outpaced closures for the first time since 2014. While activity continues to be dominated by discounters, grocers, and off-price apparel retailers, numerous fitness tenants increased leasing activity during the quarter, including Planet Fitness, Crunch Fitness, which were both among the top 10 tenants in the nation for new retail space signed in 2021. While retail store was largely positive in 2021 and consumers are still sitting on significant excess space savings, significant bifurcation remains under the surface. The reorientation of retailer locations and footprints toward a more efficient model continues to drive bifurcation in performance based upon geography, box size, and shopper center type. This is really interesting. So each of the top 10, and I'm sure we have folks calling in from all over, but each of the top 10 metros reporting the strongest growth and the demand over the past year relative to inventory are located in fast-growing metros in the South or West. At the same time, metros have struggled to create positive net demand over the past year. Overwhelmingly slow or no growth metros are in the Midwest and Northeast. So with both retail sales and inflation rising, retail asking rents increased by 3% over the past year to approximately $23 a square foot. That said, increased inflation expectations will weigh on the real rate of rental growth, likely keeping in line with or slightly below the average growth rate seen during the 5 years preceding this pandemic. So as consumers have returned to stores, so have investors. Over 159 billion of retail property traded in 2021 thus far. A total which will rise to an additional as the end of the years are still being deals are still being recorded here. As it stands, 2021 was a historic year for retail sales, eclipsing our prior annual record in 2018 by more than 20 billion. Contributing to the increase in multi-tenant sales volume recorded was the largest retail transaction of 2021, where Kimco REIT acquired a portfolio of Weingarten Realty. The two shopping center focused REITs merged in August at nearly $3.9 billion transaction, in which Kimco acquired 159 open air shopping centers. So really, really noteworthy transaction. John Bolsins, would you like to further illustrate some of the highlights on our chart?
Of course. So some interesting things to point out here would be net absorption. Total square feet of net absorption was 82 million over the past 12 months. So net absorption is the space that became physically occupied minus the space that became physically vacant. And so we had a positive net absorption of 82 million square feet. Deliveries, which is new construction, so total delivered square footage was 42.5 million. Then rent growth, not surprisingly, is 3%. So you'll see that in the 12-month column. If you shift over to historical average, what I find interesting here is that on a historical average, we're looking at really 85 million square feet that's typically delivered. So we had a significant drop in deliveries for the past 12 months. And then you'll see also rent growth historically is going to be at 1%. So it's just some interesting points to highlight there.
On this slide, guys, so we're going to talk about the retail leasing and the activity from 2021, just last year. So just last year alone, the activity has accelerated to its highest level in 4 years, with over 240 million square feet of space just leased in 2021. In comparison, this is an increase in over 30% from the multi-decade low that we saw in 2020, just 2 years ago. The increase in activity was driven by the strong growth for smaller spaces, even though the average footprint lease fell to a new historical low during that year of just over 3,000 square feet. Last year, leading the way in the leasing activity of spaces under 5,000 square feet was the company Org Capital. They're a private equity firm and they own numerous retailers across restaurants, auto service, and health and wellness industries. With their portfolio, they have fast-growing chains such as Dunkin', Sonic, and Arby's, which contributed to leasing over 210 square feet of space, again, just alone in 2021. The retailers that lease the most space, regardless of their box size, you have your Dollar Tree, which leases about 1.7 million square feet. You also have your off-price apparel and home goods retailer Burlington, which is also the second largest lessee of new retail space of last year. And they leased about 1.4 million square feet. Burlington is the perfect example of the shifting current underlying in today's retail market. They did announce this year that they intend to open 120 new stores. They're also going to close 30 underperforming stores. And while all of this they're doing, they're continuing to shrink their average square foot footprint. On this next slide here, you're going to see that the top 5 retailers that leased last year, you have Planet Fitness and Target. They leased about 1.2 million square feet. And then you also have Floor & Decor, which leased about 1.1 million square feet. But across the US net absorption, it has accelerated to 82.1 million square feet in just 12 months. This is the highest figure that we have seen since 2017. The vast majority of leasing activity and the absorption that are flowing is usually in the general retail sector and the neighborhood center sector. So you have your general retail at 41.5 million square feet, and then you have your neighborhood centers at 28.1 million square feet. But the general retail segment has benefited from this strong growth in demand due to the quick service restaurants. You have your discounters, and then your big box retailers that are in department stores. And lastly, also home good and decor, and then your home improvement stores as well. In addition, last year, general retails and neighborhood center segments, they truly benefited from this strong demand due to the grocers in the market.
Perfect. So rents, so retail rents grew, and they're forecasted to grow by over 4% in 2022. This can be the fastest recorded growth rate in nearly 2 decades. This above average pace of growth is supported by higher inflation expectations, with Oxford Economics forecasting consumer price increases of 4.4% over the same time. What I find interesting about this chart that's on the screen right now is that although we did see a dip during COVID, which was expected by everybody, this dip did not go to a negative rent growth. I find that very interesting. So this bottom line of this chart is going to be at 0%. So even malls, right, which we've all heard on the news were the most impacted, we never reached a negative rent growth in malls. Certainly positive rent growth had slowed, but it was still a positive rent growth for all the leasing that was taking place. Now, starting in year 2021, Q2, Q3, we saw a very sharp increase in rent growths and activity in the market with tenants leasing space. Now, the forecast over the next few years, it's expected to grow. By how much, still left to be determined. Based on the leasing activity that we're seeing, in-house and that we're hearing about through other folks, I do expect this rent growth to grow. I have faith in this chart. And then after 2023, the forecast kind of blends together, and it's kind of we'll see what is to come.
We think it'll probably, thanks, John. We think it'll probably become a little more stable. So all that looks like a dip. I think that's more of a stabilization of rent growth.
Construction. So a significant contributor to the balanced retail picture across the U.S. has been the minimal amount of new space that's delivered. A mere 43.7 million square feet of retail space was delivered in 2021. This is the lowest annual recorded amount in over 15 years. The vast majority of new retail space delivered over the past year consisted of freestanding single tenant properties, a fact that contributed to over 70% of pre-leased rate for projects completed in the past year. At the same time, approximately 22.3 million square feet of retail space was demolished during the year, a level that's consistent with the elevated rate of demolition seen in recent years, as developers and local municipalities have demolished over 118 million square feet of retail space since the beginning of 2017. This is because you have these older boxes that are being replaced with new and oftentimes mixed-use properties. The threat from new supply should remain minimal in the near future, as just 49.4 million square feet of retail space was underway across the US as of the end of the year. This is the lowest level recorded since 2012. Further reducing the threat of new supply is the fact that the majority of under construction activity continues to involve freestanding general retail properties that are pre-leased to national tenants, with nearly 75% of under construction retail space pre-leased as of the end of 2021.
In regards to property sales of last year, and so with the growing confidence in the retail sector, everything going back to normal and actually increasing, and the low interest rates fueled by the retail sector, just alone in 2021, it was $159 billion worth of retail property sales. Just in comparison, this actually blew all of the records out of the water. The last record in property sales was back in 2018 at 138 billion. So back in 18, it was the 138, which was the highest record. And then now with last year, it went up to 159 billion, literally after the pandemic. So huge increase, a huge difference that we are breaking some records in the retail industry.
All right, so let's get into the financial crisis versus COVID-19, the pandemic. So the virus has taken a profound toll on the economy, consumer confidence, and the financial health of some retailers. The outlook largely depended on how quickly economic activity returned and how smoothly reinfection rates could be mitigated. We've seen leasing activity significantly improve since hitting a trough in mid-April of 2020. The vacancy estimate was expected to peak at 5.6% in Q4 of 21. This is still well below the peak rate of vacancy seen during the financial crisis at 7.3%. The actual vacancy rate reached 4.65% in Q4 of 2021. And this was due to record-setting leasing that started to ramp up in Q2 of 2021 and has continued on. During the financial crisis, the market also experienced a decrease in demand for retail space, along with the delivery of 560 million square feet of retail space from 07 to 09. In the years leading up to COVID-19 and during the pandemic, for 2018 to 2021, retail deliveries were only 244 million square feet. So less than half the square footage was delivered, when we compare these two timeframes. What's interesting about these two charts that we've plugged in here below, on the left-hand side, this is going to be the forecast that we were looking at back in 2020. As we all were kind of sitting in a spot where we didn't know what was going to happen in the retail world. We were relying on a lot of data and a lot of forecasts from a lot of very trusted sources. And this is what we came up with, and this is what we were looking at. So you can see on this chart on the left-hand side, the green lines on both charts are going to show vacancy rates. The orange bars are showing net absorption. So net absorption is the space that was physically occupied minus the space that became physically vacant. And then the blue bars are going to show net deliveries. So these are going to be new construction deliveries. We can see on the graph on the left-hand side, 07 to 09, you can see how much new delivery was injected into the market and how net absorption fell pretty significantly in, starting in kind of late 08, 09. What's interesting about this forecast compared to the actual is we were expected to have 6 quarters here where we were going to have negative net absorption. In reality, when we look at the graph on the right, we had, in a sense, 2 quarters that had negative net absorption. This leads to a much lower vacancy rate and a very smooth recovery. You can see how net absorption really picked up at the end of 2021 and is expected to continue on. So we're dealing with really 2 different scenarios here of financial crisis, COVID-19, and the recovery has been very significant. So just wanted to point that out.
Okay. What has this done to our economy? After a disappointing third quarter Blamed on the spread of the Delta variant, the economy in the fourth quarter has rebounded with job growth returning and consumer spending is still very strong. More than 1.1 million plus, and they keep growing, have reported newly found work in November of 21, a divergence from the data received from the businesses that reported adding only 210,000 jobs, but a positive sign that the labor market is still on the mend after robust hiring in October of 21. The unemployment rate fell to 4.2% in November, a new pandemic era low, with a near record 11 million job openings and 4.2 million workers voluntarily leaving their jobs. Competition for workers is driving wages higher. But the labor participation rate is still well below pre-pandemic levels as workers continue to cite COVID fears and a lack of childcare options, amongst others, as reasons to stay on the sidelines. Overall, there are still about 4 million fewer jobs today than there were in February 2020. Still continued consumer spending is expected to tip the economic growth up to 7% or better in the fourth quarter, far faster than the 2.3% growth annualized experienced in the third quarter. For the year, projections for the economy to grow by 5%, at least 2 percentage points, slower than the estimates made by just a few months ago due to the spread of the Delta variant. The Delta variant remains in play. The nation is now facing a new possibility of additional constraints due to the Omicron variant and impact on the outlook of economic growth in our future quarters. So our consumer sentiment plunged through the fourth quarter on continued COVID-related fears as expectations of higher inflation. Inflation is measured by the personal consumption expenditures price index rose by 5% in November. Its 11th month of acceleration, highest rate since 1982. For PCE and the Federal Reserve's preferred measure was higher for the 5th month, reaching 4.7%, far above the Fed's target rate of 2.2%. Bottlenecks in supply chains, as we're all well aware of, persist and are not expected to meaningfully ease until well into 2022, with shortages of some inputs and COVID-related impacts on workers' training, production, and also delivery. Until conditions improve, prices are likely to stay elevated. So I'd like to open up into a Q&A session and go into some questions, Tom, that you may have. And before we do that, I have a question that I'll ask the group and pose that often gets asked to me, and I've got a very illustrative way of answering this question, and it is retail dead? Are we all going to lock in our homes and become locked in and not trade and have that activity outside of our home? I think the answer to that is absolutely not. I think that we are pre-wired as humans to be active and to socialize with one another and to have experiences in life with our families and our friends. There is a person that I quote quite often, which is whether you like him or not, he's funny, Jerry Seinfeld, and he often has a skit that he still does today, which could be featured in his episode 1, season 1 opening monologue about a little bit about this, and I thought we would play this clip, Tom, and before we go into questions, and it's noteworthy.
Do you know what this is all about? Do you know why we're here? To be out. This is out. And out is one of the single most enjoyable experiences of life. People, you know how many people talk about we should go out? This is what they're talking about. This whole thing, we're all out now. No one is home. Not one person here is home. We're all out. There are people trying to find us. They don't know where we are. Did you read? I can't find him. Where did he go? He didn't tell me where he was going. He must have gone out. You want to go out. You get ready. You pick out the clothes, right? You take the shower, get all ready, get the cash, get your friends the car, the spot, the reservation. You stand around. What do? You go, you got to be getting back. Once you're out, you want to get back. You want to go to sleep, you want to get up, you want to go out again tomorrow, right? You want to life. It's my feeling. Gotta go.
Oh, looks like we have a question that came in here. I'm going to go ahead and read that if that's okay for us to jump into this.
That sounds great.
Okay, so we have a question that came in. It says, with the rebound of the retail sector, why does it seem that landlords are not as motivated to bring in new tenants to their vacant spaces? Is there a benefit from the landlord's perspective to slow play LOI or lease negotiations?
Yeah, that's a great question. Really that's answered by market specific conditions. However, if you were to take Anywhere USA and say pocket those areas based in really two areas, a higher demographic area versus a lower demographic area. Okay, you just looked at them in that way. Meaning the population it's very dense. It's a very affluent community, and the income numbers are high. In almost Anywhere USA, you could measure that right now in real time as being a landlord-driven market. Rents are on the rise. Tenant improvement allowances for tenants are lower. The money in which a landlord may provide to the tenant to build their premises, and they are getting more offers on spaces. So there is certainly more demand than there is supply, as illustrated in those metrics there.
Great, thank you. I'd like to see if we have other questions from anyone else attending here. Feel free, by the way, to just either type something into a chat box, into the Q&A, or with the group size here, feel free to raise your hand on the raise hand feature if you want to ask that question verbally. Happy to unmute you. While we're doing that, just a kind of a quick question that seems to kind of dovetail off of the previous one, which is just with low vacancy rates. How can retailers depend and rely on retail inventory in their given market?
Yeah, with low vacancy rates, how can retailers depend on finding space in their market? With that, I would say it really depends on the agent that the certain tenant is using. Having an agent that is very focused for tenant specific needs, and really they've got to be beating the pavement, finding opportunities that might not necessarily be listed on the market. So tracking these national retailer disposition lists that are both published and then also private. Staying on top of that, staying on top of dispositions, folks who might be in default or not renewing their lease would be a really key differentiator in finding good deals in the markets during times like these.
Great. And I guess I just had another quick question. This is something that I heard of through our clients, and I really don't know if this was accurate or not, but there seemed to be a sentiment that during all of the coronavirus, COVID shutdowns and such and lockdowns, were landlords, were they more flexible on negotiations? Did that actually happen? What happened in that situation?
Yeah, I think that we were encouraged by that. And if everyone recalls, for any that are listening in that had a retail location during that time, or office space, or any type of commercial product, I can't guarantee you had success, but I can say that most of them, we were very pleasantly surprised of the landlords working with the tenants. An often trade that we saw was ownership groups would essentially extend the lease, which would push the cap in the favor of the land cap rate values in the favor of the landlord, creates more term, in exchange for giving the tenants instant rent relief, whether that be paying no rent or reduced rent. And then usually either some period of time to pay it back, spread out over a long period of time, maybe amortized over a 24 or 36 month cycle, or maybe paying it back in 12 months. And then we all know what happened shortly thereafter that, which was the PPP, and many did take part in that rescue plan. But it certainly was a very positive and encouraging experience thus far.
Yeah, and I guess just to add real quick, and we do have another question. Aaron, we'll get to your question here in one moment. Just to kind of couple with that, just curious if you saw landlords providing any sort of actual support or relief to tenants. I can tell you from our experience, our landlord that I was working with did not. He had zero interest. He didn't care. He said, pay the contract or get out, is basically what he said as that was happening. So I'm just curious what you saw, just kind of from that's a very one specific scenario. So what have you seen kind of on a national basis?
Sure. So on a national basis, I saw some pretty interesting things. So we saw certain landlords create private funds that their tenants were able to pull from. Which was very interesting. So in the retail world, we saw tenants or landlords create these funds where the tenant was actually able to pull money from the landlord, in addition to getting PPP or some of these disaster loans, because sometimes those loans, initially when they were launched maybe a little late, right, for some of these tenants. And so on a national basis, broad stroke, I saw landlords generally work a lot with their tenants in the retail sector because, it's a basic thought, but you're only a landlord if you have a tenant, right? Otherwise, you're just a company that owns a building that's vacant. So it's in the landlord's best interest to work with their tenants and, help them through that process. Now, it only goes to a certain point, but there certainly are one-off examples where, we did have some landlords in certain markets who were private landlords. And, they needed that money to come in. They didn't have any buffer there. And so they really didn't work with some tenants. But on a broad stroke, we saw those folks do that. And kind of like John was saying, we saw them tacking, the most common scenario we saw was them tacking any of that free rent or abated rent they gave that tenant during the COVID crisis onto the back end of the term and giving them a little bit of a break. Sometimes they also amortized it over a certain period of time. When the tenant had a few months of free rent, then they had to pay it back within 12, 18 months. So as soon as they picked back up in business and they were allowed to open, their rent hiked up a little bit. So
and it really was, Tom, it was multiple parties involved, and oftentimes, not to defend the nasty landlords out there, right? We fight with them every day, but oftentimes it wasn't their decision necessarily. It was their lender's decision, and so sometimes those decisions took a little long to reach, as you can imagine, with extra parties or extra cooks in the kitchen, and so they would sometimes be towards the end of the month and happening, especially in that first and second month, and oftentimes those decisions weren't reached, so it did get a little interesting, and who should pay rent and who shouldn't. During those times, but most certainly the lenders did have a very serious involvement in many of these decisions.
Great. Yeah. Thank you. Thank you for that. And Aaron, this is a question I should say asked by Aaron. Thank you for asking this. And the question's relating to about is asking if now is a good time to start a business or jump into entrepreneurship. And I'm going to reframe that just a little bit specific to retail space, and just maybe from your vantage point, and ask about, let's say there is a new entrepreneur or someone that's buying a franchise that needs to lease a space. Is this a good time to be doing it?
Yeah, that's a great question. I think that not to give it such a political answer, it is most certainly market specific and industry specific. Meaning if you were looking in one franchise for a certain block of space, there could be a lot more inventory in that territory that you had purchased, hoping to develop in, versus a smaller footprint or a larger footprint, or vice versa. We're still seeing, as much as we look at these slides and we understand where the metrics are taking us and the way the negotiations are going, there are deals out there for franchisees where we sign leases every day and every week and every month here, and it's an exciting time. There's a lot more entrepreneurs out there that have been bred by this coronavirus. We all know that. There's millions that have quit their jobs and are now looking to be their own boss, and so we remain very bullish on the franchising industry, and we think that it's very exciting to see these dreams come true, and we're a part of that every day. But most certainly, I think it's a great time to jump in. But as you know, tough questions, very market specific, related to the development there.
Yeah, that's a fair question. And Aaron, I might suggest that you reach out to John or Linda, or one of the Johns or Linda here, and post this just maybe for some specific suggestions for the market or area you're considering. They might be able to give you a little more detail or specific on that, just as a suggestion. And then in terms of entrepreneurship, as John was mentioning, I think the number of new business startups in the United States is surging. I mean, it's unbelievable the number that are starting. It's up pre-pandemic levels. We're around about 300, just short of 300,000 new startups every month nationally. And now it's over 400,000, sometimes close to 450,000 a month of new business startups. So entrepreneurship is on the mind. So I would say optimistically, I love entrepreneurship, so I always think it's a great time to go into business for yourself. But you need to answer that certainly for you, and then the question specific. So great question, thank you. Kirk has a question here, which is about: do you think commercial real estate would benefit from adopting some residential real estate rules and regulations, mainly around required timeframes to respond to offers, et cetera?
Yeah,
You would take that?
yeah, sure. So we are, I mean, Kirk, you're right. We are at kind of the hands of a landlord and landlord's brokers in responding to us. It is, in most of the offers I know with our company, we're going to put dates where we put especially in the negotiation phase of a letter of intent, we're going to put a date that when our offer expires. And so that's in an effort to get the landlord to respond in a timely manner. Now, it all depends on what type of landlord we're dealing with. And I could take this question down a couple different rabbit holes. But it's, if a landlord is a very corporate structure with a lot of folks that have to check off approvals and sending an offer back, that could delay a response back, especially during times of, we've seen some delays during COVID because folks are out of the office, they're traveling, they might be sick. And so there's a lot of workarounds, but in general, that would be fantastic if something like that would happen. I don't see that happening, nationwide, as far as getting a regulation as to you have to require, a response by the state. Trust me, I would love that. It'd make my job a lot easier.
There's also something to point. Yeah, true. There's also something to point out where this is very much different in residential as it is in commercial. So in residential, you could create a litigious situation by having multiple offers out at the same time, right? Well, in commercial, that's actually encouraged. It's done on the landlord side and it's done on the tenant side. Well, in doing so, by the nature of that exchange, that now creates essentially a built-in pause into the negotiations, right? Because if you sent an offer, and Kirk, right, you sent an offer, and John and Linda, we all sent offers for our various businesses for the same space, the negotiations would certainly slow down by the nature of multiple. And so that's not an uncommon thing.
Yeah, great. Thank you very much for that. We have another question that came in here from Chad. He says, I heard somewhere that retail space had been overbuilt for the years prior to COVID. Do you think that the lack of space introduced to the market during the last couple of years has actually helped even those numbers out?
Certainly, yeah, I can take this one. So, from 07 to 09, we had 560 million square feet of retail space delivered during that time period. To put it in perspective, I remember back in 2013, 2014, I had retail tenants who were leasing first generation space that had never been built out. That was from 07, 08, 09. Okay, so this is space that had been on the market for, 8, 9 years that my folks were leasing out. So, yeah, I think the market over the course, I'd say 2016 and on has kind of absorbed some of that overbuilt space. It was more of a tenants market. When we look at kind of 13, 14, 15, then turned a little bit more to a landlord's market, 16, 17, 18. So yeah, certainly, there's been much more controlled deliveries that have been built, not as much just rampant delivering. I mean, there's one year, I think it was one quarter, we had 100 million square feet of retail space delivered, either late 2007 or 2008. So that is just, it's just impressive. So, certainly, yeah, that's a fantastic question. Thanks for asking.
Great. Thank you, guys. And, I guess just a question that kind of spills into this a little bit, but just a general catch-all question. Are malls dead? Just curious. What are your thoughts on that?
Please let me take that one. I love that question. Malls with the right capital and the right demo, in the right developer in place are alive and well. We see the malls of the future becoming essentially flipped inside out. So look at it that way. To be outward facing malls. I'm not referring to a shopping village. I'm more referring to chopping up the Sears boxes and the JCPenney's of the world, and turning them into experience related retail offerings. And you hear that term a lot, but making it become a true destination for a family and friends could spend the entire day there. You would never really want to spend the entire day at your traditional mall. But if I told you I had indoor wakeboarding and I had bowling and I had restoration hardware and I had great coffee shops and it was essentially a true destination for everything, in a Legoland, to name a few, you could really create a dynamic thing. And we are seeing them done around the country. And they're a beautiful thing. And I think that's the malls of the future. I also think the malls of the future have office space in them. I also think big box gyms are finding their ways into the malls to occupy space. There have been multiple Fortune 1000 companies who have announced backfilling large square footages inside of malls. And making themselves the anchor of it. And we do see that that will continue. So yeah, add any.
Yes, so one story that comes to mind is this company called Epic Games. So they're out of Cary, North Carolina. So this is an example of repurposing a mall to a corporate campus. So Epic Games bought Cary Town Center. And this is like a 980,000 square foot mall that they're repurposing into their corporate headquarters. And I just think that's a fantastic repurpose of a mall. Now, are they going to occupy all 980,000 square feet? I don't know. I would imagine some of that's going to get demolished, right? There's going to be some changes done, but Epic Games is one of them that I know that has purchased that mall. So fantastic repurpose of this kind of old dying real estate that's just been vacant.
Great. Thank you. Thank you. And just another question here about, you've alluded to this a little bit, but I just would like for you to clarify if you think it's a tenant or a landlord market right now as people are out there looking for space.
Yeah. It's hard to say that it's either or, if it really, again, it's market specific, and it's also what type of business and the type of demos. Generally speaking, the higher demographic areas, the higher household incomes, those areas that have the national retailers in them are performing pretty well, and there's less inventory in those markets. But it is use specific. So if I had as by way of example, a juicing concept, and that was a position that the landlord felt fit into their merchandising plan, then they would want to fulfill that. They would go after that tenant, and they would make sure that that tenant landed there or give it their best shot. So you find threading in certain uses into scenarios where they need it in their merchandising plan or really want it, and it fits with their tenant mix. Another interesting, factor is sometimes is exposing a lender requirement. There are things where a building or a shopping center has to achieve certain milestones, or they have to pay penalties, and you could arrive at that time that you, along with a collection of other tenants, or you by yourself, are causing that metric to be met, and those are to the benefit of the tenants coming in, and they were rewarded generally handsomely for that situation, very situational. But most certainly, there is definitely more demand out there, generally speaking, in higher demographic profile territories than there is supply.
Okay, that's great. Yeah, that's what I was curious about too, about supply. Is there more? So demand is exceeding the available supply right now. So okay, that's very helpful. And then I'd like to. Are there other questions, by the way, while we have everyone on the line here? I want to make sure that if you have a question, please feel free to type it in while we have the team on to answer these specific questions that are coming in. And you guys talked about this. You all talked about this a little bit, but just curious about during the presentation, you were talking about all the different square feet of deliveries and the millions of square feet being delivered. Is that low or high, and why is that the case?
Yeah. So I would, when we compare it to like a historical average, a little lower on the historical average. Why that's the case? That is, so I think some things that we've noticed. So these are just kind of some random thoughts here, but some of this has been due to some supply chain shortages that I've seen that has caused some of these deliveries to be postponed and kind of pushed out a little bit. I've seen that make a bit of an impact. Construction costs have also really kind of trimmed that down a bit. So, but yes, it's certainly well below the the average. And just like we were mentioning, it's a lot of these buildings, older buildings, are getting demolished, and that's also really affecting the supply. So, yeah, it's really due to cost, delivery issues for materials that we've seen kind of postponing these things out.
And it's also fueled by the amount of additional entrepreneurs that were waiting on the sidelines, right, during COVID, and how many of them that have been bred into the market at the metric, Tom, that you were talking about. And now you're fueling all of those in, they're all in site searches.
Sure.
And they're all vying for, similar spaces.
Yeah. That makes perfect sense. Yeah. I have a good friend that recently bought a franchise retail business, and that they've recently gone through that scenario where it was a long process to find and wait for a space, and negotiations were long. It just took a long time. So sounds to me like, given the circumstance, if you're in the market or considering retail space, you should have gotten into it yesterday. And if you didn't do it yesterday, you probably ought to look at doing it today, given the demand. I'm not trying to do a sales pitch for you guys, but that's kind of based on the information you're saying here. What it like practical takeaway here is, if you're in the market for retail space, you need to get in and do it now, as soon as possible, because it doesn't appear to be slowing down for the demand, and buildings can only get made so fast. I mean, construction takes a long time. So especially with, as you've mentioned, the supply chain shortages, lumber shortages, shipping delays, all the stuff that's going on, steel shortages and delays. So all the building supplies. So, well, this has been great. I'd love for you. Do you have any closing remarks here or anything before we bring this to a conclusion?
No, Tom, I mean, on behalf of Linda, John, and myself, thank you for the discussion. We thoroughly enjoyed it. We most certainly like to nerd out on all of this. We're data nerds at heart, and so we really do enjoy it. And hopefully, we kept it in a way that was engaging, and we don't want everybody to glaze over. But we really do appreciate the discussion at the time.
Great. Well, thank you all for being here. And to our guests who tuned in, thank you for participating. We do host these events almost weekly, every week at noon Eastern on every Friday. And if you have not subscribed to our podcast, please take a look at that. Multiply Your Success, available at any of your favorite podcast services. And thank you all. Thank you, Morrow Hill team, for being here. So grateful for your time. Everyone have a great weekend, and we'll see you back next week.
Thanks, Tom.